Hello everyone, hope everyone is doing well. So the today's topic is accounting cycle. Where is the cursor? Okay. So today we are going to wait a second, I'll just move this. So what exactly is accounting cycle? So I'm going to discuss this with you. So here are the few steps on the screen, and then we are going to discuss some additional points, which is regarding financial reporting, auditing, taxation, management reporting. So we're not going to go in very much detail for all of these, but I'm going to uh, give you a very little overview so you have the idea of what exactly is happening and at which point exactly we are, when we are going to go in detail. So starting from the first point, that is source document. So for example, let's say a friend of yours, he makes a commitment. Oh, oops, sorry. Okay. So he makes a commitment with you to sell his car, let's say. Commitment to sell his car for 500. Are you going to record this? The answer is no. Then let's say you get the electricity bill for the month. Electric city bill of, let's say, 150. So are you going to record this? Yes. The answer is yes. So what exactly is happening here? See, the thing is, you only record a transaction which has already occurred. It does not matter whether you have paid the transaction, you have made the payment for the transaction, or you have received the cash for the transaction. But if the transaction is occurred, then you are going to record this. But commitments like to sell something or to purchase something, you do not record it as per the accounting principles. Okay? So, for example, you made a purchase and you got the invoice for that. Are you going to record it? Yes, because you have done the transaction. Bank statements, that's obvious because it includes all your transactions, so that would be included. What about the payroll records? You have made payment to the employees and much more. So you are going to record the transactions through that and the bills like we discussed. All right. So moving to the second point. So let's say, for example, you are in a car selling business and you make the sale for the car. So what is the transaction you are going to record? Let's say you sell the car for cash of 500. Okay, so I'm not going to discuss here about the debit and credit rules because in my previous lecture I gave an overview. And if any one of you have any doubt regarding this, so they can drop a comment and we can discuss further. But I'm not going to go in very much detail of why the cash is being debited and what is being credited and why. Okay. So okay, so let's say you're making a sale of the car and you made the sale on cash. So you're debiting cash and crediting sales of 500. So what exactly happened here? You made the sale. So for that, you generated a sales invoice for that. So that would be your first point. Okay. So using the sale invoice, you are going to pass the journal entry, which would be debit cash and credit sales. All right. So this would be your second step. And then moving towards the ledger accounts. So what exactly is ledger account? Ledger accounts, before diving into deeply, let's say ledger accounts are a group of accounts for which you have made the transaction. For example, here you have made a cash transaction and here you have sale transaction. So just a very little overview that in accounting we are using T account system. So we have a ledger of cash, oops, and we have a ledger of sales. I'm sorry, what is this? Okay. So the cash here is being debited. So we are going to record it on the debit side because left side is the debit side of the T account and right side is the credit side of the T account. So that cash is being debited, so we recorded it here. And sale, and on the other hand, is being credited, so we record on the credit side. Okay, so let's say this is basically a group of accounts that are being used. This is a group, this is a group, and for example, you also made some purchases during the period of your business. So you have the group for the purchases, same debit here, credit here, and so on. Okay, so but normally, practically speaking, you won't really see this T account in the ERP systems, for example, the accounting systems that are being used in the businesses, okay? So that is not, you don't really visually see the T account system. It's not necessarily, they could be, but normally you won't really see such accounts on the system. Okay, so moving forward, we made transaction, we recorded it in our ledger accounts, and then moving towards the trial balance. What exactly is trial balance? So trial balance include all the balances that have been recorded in your ledger accounts. So let's say the trial balance. Yes, so the trial balance includes all the accounts that were included in your ledger accounts. This would be your third step. I will just, okay, I'm just gonna move this away from the screen. And where is marker? So this was your third step. And your fourth step would be the trial balance. So like I said, the trial balance includes the summary, the final balance of all your T accounts. Let's say we have a TB stands for trial balance, and then you have the account name and the debit balance and the credit balance. So, for example, you have the cash account. For the cash account, you would have the debit balance for this. So that would be recorded here. For sale account, you have the final credit balance. It would be recorded here. And purchases have the final debit balance. So that's recorded here. And down below, you would have the final total of the balance. So like this, you would have some other balance: purchases, bank, liabilities, expenses, and so on. So, the final balance you would have written down here. And this should be in a trial balance. Debit side is always equal to the credit side. Okay, for all the students who are wondering what am I doing here, why the cash is being on the debit side, why sale on credit, purchase on debit. So it is all related to the nature of the account. All right. So if anyone wants to discuss it in further, they can drop a comment, and I'm going to make a separate video on this as well, where I can discuss in detail what exactly is the nature of account. So for now, just understand that cash is recorded. Cash has the debit nature, so it's recorded on the debit side of the trial balance, sale credit, and purchase on the debit side. So basically, trial balance is a very important point before you prepare your financial statements, because trial balance also ensures the arithmetical accuracy of your records. For example, there could be mistakes like, let's say, you recorded the sale of the car, so it was supposed to be debit cash and credit sales, right? But instead, for example, what you did, the uh, you credited the sales, that was correct, but you also credited the cash at the same time. Wait a second. Yes, guys, I'm sorry. I got the call, so I paused the recording due to that. So for example, you had the transaction, like I said, you were supposed to debit cash, but instead you create the cash account instead. So what happens here, when you would wrongfully create the cash account, so the debit, when you ultimately add all the accounts, so debit side won't be equal to the credit side, right? So this would help you ensure that your accounting entries have passed correctly. So if you find out that both are equal, so that means your trial balance is accurate most likely, and then you are going to proceed towards preparation of your financial statements. So this video has gotten quite long, so I'm going to record it in the part 2 of the same video. All right, thank you.